All right, folks, this past week in the equity markets was volatile to say the least. US equities got hit hard as the tariff war started, and then Europe got hit hard when Germany announced that they're going to do a massive defense spending because their rates then exploded higher. What does it all mean? What's the current value of stocks, and are they good investments for the foreseeable future? That's the question on a lot of people's minds. And I walk you through a few charts here to give you an idea of where things stand. So in this first chart, it shows you that the GDP now, which is kind of a forward-looking indicator on how the US economy is doing, it recently in the last few weeks went from a positive number to a negative number, signaling that the US is going into a recession in the near future. This indicator spooked the market. Okay, so this is the first one. The next one, this one shows you earnings per share forecasts for the S&P 500. And as you can see, for this year, next year, and even into 2026, the market is expecting higher and higher earnings per share. Okay? On the top left corner, you can see the box there. That shows you also that as the year progresses, typically earnings per share actually trends lower as the numbers actually get realized and it comes to fruition, meaning like what actually transpires usually isn't as optimistic as what actually happens. Okay, moving on from there, now we look at PE ratio. A lot of people that invest will know what PE ratio, it's price to earnings. And as you can see here, the price to earnings is relatively high on a historical basis. The PE actually right now, March 2025, is at 38 for the S&P 500. 38, okay, huge number. And then moving on to this next one, this is a really telling table. So as you can see here, they took 10-year periods over since I think it was the early 1900s all the way up to 2024, and they looked at sequential 10-year periods and they measured what the return was for the S&P 500 based on the starting PE ratio, and then also compared to what the ending PE ratio was. And as you can see, the point I'm trying to get at is if you see at the top, when the PE ratio was starting out at 26, the average return for the forward 10-year period was actually 1.5%. Remember, we're at 38 right now, 38. So this doesn't bode well for the next 10 years in terms of performance if you invest in the S&P 500 based on a valuation metric. This is a really interesting analysis, and it makes you question whether or not you should just be sitting long the S&P 500 or equities in general. I think to be successful over the next 10 years, you got to be a lot more strategic. You got to really understand the risk of your investments, and just buying an index like the S&P 500 is probably going to return you, probably inflation. So if inflation's 3%, you might make 3%. So in real terms, you're zero. If you pick the wrong particular stocks, you could lose a lot. If you over leverage, if you pick the right ones, you could do okay. But it's definitely going to be a challenging time, just because where we stand today, things are very, very, very rich in terms of valuation, and we live in very uncertain times. So keep that in mind when you're looking at your investments and when you're contemplating what went on this past couple of weeks with all the volatility in the stock market. Take care, everyone. Bye.